All right, welcome everyone. I'm Ted Erhart. Today we're talking about one of the most common tax traps for retirees, that being surcharges on your Medicare premiums. This is also known by the acronym IRMAA. And I see this so commonly that I want to help people understand what it is and also describe a couple common scenarios that lead people right into this trap. And then we'll finish up by talking about how some basic planning can often get you around it. So I hope if it's helpful, stick around. All right, so we have to start by just describing at a high level how Medicare premiums are set for individuals. And it's very simple. Basically, it is all determined off your income from actually 2 years ago. So for example, take a look up at the table here. These are the premiums for 2022, monthly premiums that is. And basically, to establish these, what Medicare is doing is looking back to your 2020 income tax return, determining what your modified adjusted gross income is to find out where you fall on this scale. And it's quite simple. You know, if you're an individual tax filer in 2020 with $91,000 or less, well, your monthly premium is $170 basically, and that's basically double for joint filers. But you can see as your income rises, so too do your Medicare premiums. And this is where lies the Medicare trap, which we'll get to in a moment. Now, if you're a little bit more technical like me and you want to know exactly where Medicare is getting their data for determining your premium, you got to go to your tax return. And again, Medicare is always looking back 2 years to get this information. So we're going to look at, here's a snapshot of the 2021 Form 1040. Basically, you got to drop down here to line 11 on the 2021 form, and you can see adjusted gross income. And for the vast majority of taxpayers, this is going to be the figure used to establish what your Medicare premiums are. But it is technically modified adjusted gross income, and the difference is for those individuals who have a whole bunch of municipal bonds that are generating tax-free interest, well, for the purposes of calculating these premiums here, what Medicare does is they add that tax-free interest to your adjusted gross income, or that line 11, to establish modified adjusted gross income. Now, let me describe the Medicare tax trap, why it exists. And it's kind of twofold, but number one, basically, there's no phase-in between these brackets. It's just a hard cutoff. So for example, let's say you are the unlucky person who had $91,001 on your individual tax return back in 2020. Well, for 2022, because you are $1 over this threshold, it's going to cost you some cash in higher Medicare premiums. And this is why this trap exists. Just slight changes in your adjusted gross income, or modified adjusted gross income technically, can push you up into these higher brackets. Now, the other reason this is a common tax trap for retirees is the vast majority of folks who retire have done their savings in some type of tax-deferred or pre-tax savings vehicle, like a 401k or an individual retirement account, an IRA. And the issue with those is anytime you pull money out, take a distribution, that is going to increase your adjusted gross income. So there's a couple scenarios where I see people inadvertently get caught up in this and end up with a pleasant surprise a couple years down the road. So the first scenario is when someone is going to take a lump sum distribution from a retirement account. The problem with taking a big lump sum out of a retirement account is it ratchets up your adjusted gross income, because in these pre-tax retirement accounts like 401ks, IRAs, the money's all taxable. So you might be asking, well, what type of scenario are we talking about here? Well, I'll tell you what, I've been helping people retire for 15 years, and things come up all the time. People want to do home improvements, they want to buy cars, go on vacations, sometimes pay off debt. And you take a big distribution out of an account, and it's going to really push your adjusted gross income up. And a couple years down the road, when it's time to determine your Medicare premiums, you might find yourself in these upper brackets. This happened to a client of mine who called me up a number of years ago and said, send me a big check. It was for over $100,000. The client wanted to pay off some debt and didn't do the tax planning. Unfortunately, this particular client, walked right into this tax trap unknowingly. So the other thing that often results in people walking into the Medicare tax trap is required minimum distributions. So under present tax law, once you turn age 72, you have to start taking distributions from tax-deferred accounts, specifically pre-tax accounts like 401ks and IRAs. And look, a lot of the folks I work with, have been good savers, have $1 million plus. And basically the way the math works out, in year one, when you turn 72, about 3.9% of your retirement account has to be distributed. So 3.9% of $1 million, well, that's $39,000. So imagine, if you're a married couple and your adjusted gross income or your modified adjusted gross income has been in that $140,000 to $150,000 per year range, well, now you hit 72, and if you haven't been taking any withdrawals, let's say the RMD, the required distribution, is just going to stack on top of your 140 to 150 that you've been averaging. Well, boom, all of a sudden you're right at the top of this first bracket and could inadvertently be pushing over here without you even realizing it. Now, the thing is, by just doing some basic planning, very often you can avoid getting knocked up into these higher brackets. Okay, so for example, in our first scenario that we talked where people need to take a lump sum distribution, well, one of the classic planning strategies is trying to spread that out over 2 tax years. So let's say, it's late in the year, for example, or if you plan this out well in advance, you could take a distribution. Let's say you needed $50,000. Well, you could take $25,000 in December and $25,000 in January. That's going to spread that out over 2 tax seasons, and it's going to allow you to manage your adjusted gross income with some proper planning. The other thing is with required minimum distributions, sometimes, there's not a lot you can do no matter what. You're going to be getting pushed up into these higher brackets, but there are strategies. There's things such as qualified charitable distributions. This is a common strategy that we employ, especially for those who are interested in being charitable. If you give your RMD, your required distribution, directly to a charity, that will not hit your tax return and jack up your adjusted gross income. But it has to be done properly. So my point is, with some proper planning, many times, in many cases, you can avoid inadvertently getting kicked into some of these higher brackets. And the worst situation ever is, when you're kind of right on one of these thresholds and you look back, you're like, if I just would have kind of planned this out a little bit, I could have, given a little money to charity via, a qualified charitable distribution, or if I would have, spread these out a little bit, or maybe if I would have taken money from an account that wasn't going to add to my adjusted gross income, this wouldn't have happened. I'm being too long-winded here, but my point is planning matters. And by doing some of these simple things, you can avoid some of these big surcharges in your Medicare premiums. So that's the Medicare tax trap. I hope it was helpful today. Hey, you know what? I've really stepped up my game on the tax planning side because I think there's just a tremendous amount of value that can be added when we're working with clients. And if you're not working with an advisor that spends any time on taxes and you want to have a conversation, please feel free to reach out. I mean, that's the whole point. That's what we're here to do. Anyway, I just want to say thanks for watching as always, and I hope we'll see you in the next one.